Hi everyone, it's time for our 20 Stock Weekly Challenge again. Before I carry on, let me just introduce myself. I'm Joel. Sad to say my wife Sarah is not here today because she's busy clearing out her wardrobe. Yes, you heard right, clearing out her wardrobe. So I guess this holiday season has done some damage to me, and I hope the damage for you has been under control, alright, especially the men in the house. Okay, we are husband and wife team, and we believe that together we are better. Alright, so what am I going to share about today? It is a company that actually gives a 4.66% dividend yield as of now, and it is without any withholding tax. So it is not a US company, okay, and it is none other than our DBS Bank. Okay, the ticker symbol for this bank is D05. Those who are Singaporeans or those who have been living in Singapore for a long time, for quite some time, you should be quite familiar with this bank. Actually, you see pretty much everywhere. All right. So before I carry on, okay, I'd just like to reiterate that this following content is really for educational purposes. This is not a stock recommendation. Later, you will know why, especially now. Okay, and please do your own due diligence before taking any action. Okay, just a quick look at DBS financials. We can see that the revenue has been increasing throughout the years, so has the earnings per share. Okay, even the dividends, they are increasing slowly. All right, and the payout ratio has been quite steady at a rate of around 50 or slightly less than 50%. All right, book value per share has been increasing, which means that this company over the years has been accumulating more assets than liabilities. All right, so free cash flow, so far not too bad, except for 2018 and 2017. All right. Okay, so if you look at the net margin, actually it is at 40%, which is not too bad. All right, return on equity, 12-13%, still okay. And what's more is interest coverage is very healthy. That's why it's a nil. And the debt to equity ratio for this bank is at a very low 1.13. Why do I say low? For banks, it is quite normal to have D ratios of up to 5 or even 10. So for DBS banks, for it to have a D ratio of 1 to 1.13 is actually very, very healthy. All right. So one of the first things that I like to look out for in banks is the NPL ratio, or what we call non-performing loans. These are actually loans that the bank has deemed as non-performing, which means to say they are unlikely to recover the full amount with interest on time, or they may not be able to recover the debt at all. So this is called the NPL ratio. For DBS, you can see in 2018, 2019, or even 2017, it has been hovering around 1.5, 1.6%. So sorry, not 1. It's in percent. So I would say it is very healthy, because anything under 2% is for a bank. NPL is considered quite good. So you can see DBS is 1.5, 1.6, so definitely it meets the criteria. So the next thing that I will want to look at is actually the capital adequacy ratio. What does it mean? It actually means the amount of capital that the bank has that allows it to cushion all these non-performing loans. So this is, to me, very, very important for a bank. Every bank will have non-performing loans, definitely, because when you lend money to many people, not everybody may return it on time, or not everybody may return the full sum. So the bank will always need to have some capital set aside to cushion all these losses. So imagine a bank that is not even able to cushion all these non-performing loans. So that will be a risky bank to invest in. So we can see for DBS, the tier 1 CAR, or capital adequacy ratio, is at 14.7 times. So what this means is that it can almost enough capital to cushion this NPL almost 15 times. And if you look at the total capital adequacy ratio, it rises to 16.4. So what is this tier 1 and tier 2? For tier 1, it actually consists of equity, your shares, audited revenue reserves, and their intangible assets. Tier 1 is tier 1 is usually the go-to fund because it is easily available and it does not affect any bank operations. For tier 2, usually for a bank to touch the tier 2, it will mean that the bank is in trouble because it consists of unaudited retained earnings, reserves, and their loss reserves. So when do the bank need to go to tier 2? Usually when the bank is winding up because it has expanded all its tier 1 CAR. So actually for investors, when we see a bank actually touch its tier 2, it is a little bit more risky. That means the bank is in great danger of closing down. So a simple formula, it will be the total CAR will be the tier 1 plus tier 2 divided by the risks weighted rate assets. These are the assets that the bank has deemed to be risky. Alright. So now that we see that DBS is actually has a low NPL ratio, and what's more, it has enough capital set aside to cushion all these losses. So the next thing that I'm interested in is actually whether the bank is making money over the years. So for a bank to make money, it has a few ways. The main way is actually the net interest income. When it, let's say, it lends money to you and me at a higher interest rate than when we put a fixed deposit, we get a much lower interest rate. So this is called the float. Alright. An example will be when I borrow money from the bank, it will charge me 2%, 3%, or even 4% interest. But when I put money in the bank, it only gives me a 1% interest. So the difference is called a float, and many banks, this is one of the main methods of generating income. So we can see from this screenshot of the financial report, alright, over the quarters, the net interest income has actually been increasing. So to me, this is a good sign, alright. And the float, the net interest margin, which is the float, is actually 1.9%, which is considered quite okay. Alright, it is not too high because it also doesn't want to expose itself to too risky loans. Right, that will also explain why the NPL is actually quite low. Alright, so the next way of the bank generating income will be the non-interest income, which means the income that does not come from interest. So these are your brokerages, your investment bankings. So even when you see here, other than the brokerage, most of the categories, they are actually earning more and more every quarter. So this is this is a good sign. Alright, so other non-interest income will be your trade, how the bank invests, alright, when they trade. So again, this is actually increasing again. So compared to third quarter of 2018 and the second quarter of 2019. Okay, so again, this is a good sign. Alright, and the next thing that I would like to check for a bank is actually how it diversifies its portfolio. So even for investors like us, small private investors like us, individual investors, we know the importance of diversification. So the bank, because it does so much investments, it does so much leverage, so it must know this very basic principle as well. So I would expect the bank to actually diversify their revenues of income. So for DBS, there are four main ways. They have consumer banking, institutional banking, treasury markets, which means trading, alright, and others, alright. So treasury markets are treasury products, okay, and others, they mean actually the trading arm of the bank, the investment, the trading arm. So I would say so far so good. They have a few ways to generate their income, so this should continue or it should even improve. Alright, for DBS, so far so quite healthy. If I were to check out on the diversification by industry and by geography, we will see that they actually have a few different industries where they go into manufacturing, building and construction, housing loans, even transportation. So this is something that I want to see also. I don't want the bank to actually park most of their money or all their money on just a few sectors. And same with geography, I don't want to see a bank that is super reliant on like only one or two countries. It should be quite diversified. Alright, so for DBS, you can see that it has quite a wide reach over Asia. Okay, Singapore, Hong Kong, China, Southeast Asia, as well as the rest of the world. But of course, for now, it is more concentrated. It is more focused in the Asian market. To me, which is okay. Okay, so one thing that I'm very interested in DBS is because of the dividend. Number one, it does not have withholding tax, and so far, I think this is one of the best, if not the best, Singapore bank that I know. Alright, that I see everybody using, including myself, a lot of my friends. Almost everybody would have a DBS account, or even a lot of people I know like to take loan from DBS, especially the housing loan, refinancing of their houses. Alright, so you can see that for shareholders, 59% of their income, okay, actually is distributed to shareholders. Okay, so what this means is that the bank actually keeps a lot of its money to redistribute. So, and you can see the rectangle in blue, their policy is to pay sustainable dividends over time. Alright, and they want to be sustainable and they want to increase their dividends paid over time. So this is, for investors, this is very good news. Okay, so for DBS, I think they have quite a conservative approach, but yet I think it is sustainable and it can grow. Alright, so if you are aiming for a 5% dividend yield, you should buy DBS only when it falls to $24 or below. As of now, I just checked, it is $25.82, so it is a little bit above our target. Alright, so if you look at the charts, we can see that it has been actually going up and down sideways for quite some time. And over here, right now, I think there's a very strong bullish momentum because the exponential moving averages are all indicating a bullish momentum, and it has just bounced off the strong support from a moving average. So definitely, it is in a very good mood for a bull run. So if you are more interested in trading, you can enter now, and it should go slightly higher than now. Okay, and you can consider selling. But for me, I'm entering DBS more for the dividends, so I would want to wait a while. Alright, I may not want to enter now. Okay, so let us know what you think of this company that gives a 4.66% dividend yield as of now. Okay, would you invest? Would you not? What do you think of DBS? Let us know in the comments. Okay, so this is week 6. I'll see you in week 7 again for another company. Okay, till then, see you. Bye bye.